Hey guys, welcome back to the channel. In this video, I'll be breaking down my Treasury allocation strategy for my portfolio and explain why I'm including Treasuries now. I'm still a small growing YouTube channel, guys, so if you like the content, don't forget to smash that like button, hit subscribe if you're new so you're alerted every time I publish a new video surrounding finance, news, stocks, and investing. I also run a open and free Discord if you're interested. Link will be pinned down below in the comment section. With that out of the way, guys, let's hop into the video. All right, so we're going to start here in the portfolio. You guys can see I have a huge equity position of $324,000. Now, this portfolio is very, very high risk, okay? Please don't copy my trades. Don't copy what I'm doing unless you understand what I'm doing, all right? So I have high yield ETFs like PLTW, NVW, Chippy from YieldMax, XPay, XET from Roundhill, and then Misty, I just included this as well, all right? So why is this portfolio so risky? All right, simple. I use a lot of margin, an excessive amount of margin. All right, I use all of my margin. So really, this portfolio value is about $620-ish, or actually $640, $640,000. Excuse me. So right now, I am low risk on margin status. Okay, I would have to lose a account value of $119,000 or 37% before I get into what's known as a margin call. So I have to keep this at the top of mind. Even though we might be in a new bull market, I still want to be cognizant and aware that a drawdown or a pullback can happen at any time, or a black swan event like we had for Liberation Day or Liquidation Day, where President Trump implemented the tariffs, and then we saw the stock market crash 25 to 30%. Again, something like that can potentially happen again in the future, although we never really know when it will happen. All right, so I want to just keep that in the top of mind, especially since we have some things coming up, which I'll be explaining during the slide presentation. All right, so I purchased $50,000 worth of SGOV. These are 0 to 3 month Treasury bond ETF. Okay, this is what this is. You guys can see here the purchase. I have $50,000 in it, and it's about 499 shares of this. Okay, this is a very stable asset, as you guys can see. It doesn't really move up or down. There's really no wild swings. This you see right here, this spike up, is because back in 2022, the Federal Reserve was hiking interest rates. Okay, and these Treasury ETFs, they're more or less linked indirectly to that federal funds rate. So, this is where the yield for these Treasury bonds come from, is from the federal funds rate. All right. Indirectly, of course. Now, I had my pick. All right. I decided to go with SGOV just because, all right, I just know SGOV and I just chose to go with it. It has the lowest expense ratio of the bunch. But you can also, consider Roundhill's week. All right. This is a weekly paying T-bill ETF. All right. The dividend yield is going to be about the same. The expense ratio is a little more higher. And then of course you have Spider's bill ETF, right? This is also a 1 to 3 month T-bill. And again, the expense ratio is just slightly a little higher, but these all pay about the same yield. All right. There's really not that much difference between them, aside from, week being able to pay you every other week. All right. But it's not going to be paying you every other week at a 4%. All right. This is a 4% when annualized. So just keep that in the back of your mind. So this is the portfolio capital stack, if you will. All right, I have $643,000 in this portfolio, or the portfolio value, but $318,000 of that is in margin. So this is a very high risk portfolio. So I always have to consider this, especially when I'm looking at the future, or looking at risks, or doing some type of risk management on this portfolio. So let's talk about it. All right, let's talk about this allocation strategy. So here we have the updated portfolio allocation. We're going to be talking about Treasuries. All right. You guys may have saw my last video where I talked about the Bitcoin strategy that I'm including. All right. This is going to add volatility to this portfolio. I also have fixed, or not fixed, but high yield income ETFs. This is also risky. Okay. This is also introducing risk to the portfolio, which I'll talk about here in a moment. And then of course we have REITs, which is the unloved sector right now because it's tied to real estate, and real estate has been pretty much in a bear market for about 3 years. So hopefully in 2026, we'll see that turn around. Things are starting to look way better for REITs, especially with the passing of the OBBB. All right, so I also have a sector index, which is just for growth. Okay, so let's talk about those risks with high yield ETFs. We're gonna start here. All right. And then I'll move into why I'm including treasuries a little later. All right. So bear with me. So high yield ETFs, they come with three different risks. Okay, you have NAV erosion risk. All right, believe it, don't believe it, I don't care. I do believe in NAV erosion risk, and I do believe that some of the ETFs I hold do have this risk tied to them because of the high distributions that they pay out. So I just want to be cognizant of that, because as a ETF goes down in value, right, from high distribution payouts and things like that, your margin maintenance, you get closer and closer to your margin maintenance requirement. And that is not good. All right. This is why I don't have just a full portfolio of just high yield cover call ETFs. You also have broker risk. Okay. This one is something that isn't talked about much, but it's what this is, right? IBKR, Robinhood, for certain ETFs, for certain stocks, they can increase the margin maintenance requirement whenever they feel like it. Okay, for IBKR, they increased it to 100% for fully exposed portfolios to MSTY. All right, these were the people that were taking out HELOCs and personal loans, and stealing from probably friends and whatever to go all in on Misty. I'm just joking, of course, but they all went all in on Misty, and they took margin. And IBKR said, hey, that's way too risky, so we're going to increase the margin maintenance requirement and take away some of your margin, right? We're no longer going to be receiving a margin loan, which is crazy, right? There's other portfolios that will see a 50% increase because they have diversification. They probably have some growth ETFs, et cetera. But anyways, beside the point, this is broker risk, okay? And they can do this anytime they want. Robinhood, M1 Finance, IBKR, Fidelity, Schwab, Vanguard, it doesn't matter who, they can increase these margin maintenance requirements at any moment. All right. So just something to be aware of. And of course, for the last one, we're going to talk about market risk. Now, I did a video on my market predictions for the rest of the year. So we're just going to cover the headwinds. All right. Because I think these have, some probabilities of occurring. And if this happens, this can absolutely impact the stock market. All right, we already know this isn't going to happen because the OBBB was just passed today, all right, July 3rd. So this is a huge deal. Again, anyways, we're not here to talk about tailwinds, but anyways, we can probably scratch this off, low probability, right? But trade deal uncertainty can still continue into 2026. If this continues into 2026, I can predict, or at least my prediction is that we will have a very rocky time for the remainder of this year and definitely into 2026 if we do not get these trade deals fixed, because we only have at the moment, it's only been announced, there's only I think like 4 to 6 out of a possible 90. So again, this is kind of concerning, especially for me as an investor and someone who kind of had sleepless nights during Liberation Day or Liquidation Day, whichever one. We also still have the odds of a recession still pretty elevated at 30% to 45% over the next 6 to 12 months. So something I'm just keeping an eye on. I'm not worried too much about this, but I am worried about black swan events occurring again. Something like another Liberation Day where we saw the stock market drop, 30 to 30% basically. We saw a huge drop. So I have to keep that in mind. And then of course, real estate for me, because I'm invested into REITs, I have to keep that in the back of my mind. We also have the possibility of continued sticky stagflation, right? Inflation increasing or being hard to get rid of, or a slowing of the economy over these next 12 months, which could possibly put us into a recession. And if we get into a recession, this will cause the Federal Reserve to increase interest rates. All right. So again, these are all just risks that I see or I predict, that can happen given with what is currently happening. So, because I'm using so much margin, again, I'm using, $300,000 worth of margin here. I have to keep this in mind because this is a huge risk. All right. So let's talk about why I'm including treasuries. All right. So I need basically a portfolio buffer, and treasuries fits that bill very nicely. Okay. So, you're going to get an additional layer of protection for your margin buffer. All right. This provides a cushion during, 30, 40, and even 50% drawdowns, depending on the allocation that you have. And I'm going to show you some charts on what this actually looks like. This should prevent a portfolio implosion. All right. That's when you have the NAV eroding ETFs, going down in value, getting closer and closer to their margin maintenance. That's when your whole portfolio is going down in value due to market risks. And that's when you also have brokers increasing the margin maintenance requirement on your portfolio. So that's just getting you closer and closer to portfolio implosion. All right. And then this one is a big one for me because I like to learn from my lessons, and the PLTW lesson is a big one. So during, those really volatile April days after Liberation Day, I ended up selling PLTW, unfortunately, right? I didn't lose any money on PLTW. And this was a huge lesson to learn. I did it because I had fear, right? I was basically fearful that the S&P 500 was going to continue going down, and this would basically cause a portfolio implosion for me. So I flocked to cash, held PLTW, sold out when I shouldn't have. And then, like clockwork, of course, PLTW saw a 20% gain right after that, over the next couple of days. So it is what it is. Fortunately, I didn't lose any money, but this was one of my most expensive high yield investing lessons. And this is something that I definitely keep in the back of my mind. All right. I can appropriately size SGOV based on what is currently happening in the macro environment, right? If we're in a bull market, there's a lot of certainty, a lot of new deals being made, companies are doing good, earnings are doing good, then I can lower SGOV as I see fit, right? I don't have to keep it at any certain allocation. I increase it and decrease it. It's a very flexible, ETF. So this is why I like this allocation, right? And I'm going to show you some drawdowns and how much amounts I would actually need for each of these drawdown simulations, okay? So why SGOV, all right? So why SGOV, why Treasuries? This is going to act as additional protection against the three market forces that I showed you, all right? NAV erosion risk, market risk, and broker risk. All right, this is a strategic cash pile for taxes and margin buffer, as well as a tactical war chest of dry gunpowder. So I don't think it's talked about enough, but especially in the high yield space, a lot of people just spend the dividend. We don't really take into account taxes. I mean, I use a lot of my money to basically reinvest back into holdings, right? Reinvest back into high yield ETFs or REITs or et cetera. But taxes is something I, definitely want to keep in the back of my mind. And instead of taking it off Robinhood, moving it to, a bank account and then keeping it in cash, I'd rather just keep it in SGOV and then keep it as part of the portfolio. And when I do need to draw down or when I need to take a distribution to pay for taxes, then I absolutely can do that if I'm not using the distributions paid out from high yield income ETFs or whatever, right? Of course, it adds that margin buffer. If we're to ever see another drawdown of any type, okay, this ETF will be that war chest of dry gunpowder. I would be able to go out and purchase stocks, ETFs on discount. So this is why I also like having SGOV. I know the burning question is going to be, why don't you just hold cash? But I'll explain that here in a second. Okay. The interest on idle money will be at 4%. This will obviously get cut if the federal funds rate goes down. But right now, 4% on your money, not bad. Okay. You're not going to get any wild swings up or down. It's very stable and predictable. All right. This also helps with interest payments on margin until the federal funds rate occurs. So I'm earning, 4%. I have to pay a margin interest of about 5.25%. So again, this money that this ETF is providing will be able to help pay some of that down, right? Or pay off some of that interest. All right. So that's always good. And then interest should be exempt from state and local income tax, versus keeping the money in a money market account or a, Robinhood cash sweep account, which is going to be earning about 4% anyways. The interest from SGOV is actually exempt from state and local income tax. Of course, you need to consult a tax professional for that. All right. Don't take my word. I'm not a tax professional. This is just what I found on the interwebs. All right. Psychologically, this is the second big one for me personally. Psychologically, is going to keep me from making buying or selling mistakes by being fully invested. Okay. By being fully invested, I have no spare cash to spend. All right. I'm not going to be dollar cost averaging when I shouldn't be. I'm not going to be spending money where I shouldn't be, or taking money out of the brokerage to, buy things, right? When I'm fully invested, it's like protection against myself. Okay. So I can actually keep it all there. If something happens, a drawdown, well, I have a tactical war chest of dry gunpowder. So this is why I'm including treasuries and why I think it's important, especially given, some of those, that market risk that I explained earlier. And again, this is the burning question, right? Can't you just hold cash and get the same benefit? Yes, you can. But again, when you're thinking about taxes and psychologically, I prefer just to own SGOV, put all my free capital into SGOV. All right. For me, it just makes the most sense. All right. So let's look at some simulations here. So I uploaded my entire portfolio into my artificial intelligence and basically said, hey, give me some information, right? It says I have a total portfolio value of $638,000. And this was interesting. I have a weighted average margin maintenance requirement of 31% or 31.25%. I think this is extremely important. So we would have to see a market drawdown of 31% before I would start getting into dangerous territories, right? Margin call, that kind of stuff. So I thought this was really, really cool. So I saw an option here. Let's simulate how much SGOV I would need in order to survive a 30, 35% or a 40% drawdown. Maybe another Liberation Day or another Black Swan event or something like that. Like, how much money would I actually need in this portfolio? And this is what it told me. All right, to survive a portfolio drawdown, all right, I would need $11,000 or basically $12,000 for a 30% drawdown, 35 percent, or $33,000 for a 35% drawdown, or $55,000 for a 40% drawdown. Obviously, I'm in the 55% category or $55,000 category, right? I put $50,000 in. This honestly is very, very conservative. And the beauty of this is that it's flexible. So I can actually take money out and then just put it to work in other ETFs or stocks or what have you. Once we get past these tariffs, I think this is really the biggest short-term risk right now. So I can draw down later after we get more certainty. But for now, I just want to be a little more conservative, have a little more money in this war chest in case something happens. All right. So that is pretty much going to do it, guys, for this entire video. All right. I know we went a little long in the tooth. I hope you guys got some value from this. I hope you enjoyed the video. Hope you got the juices thinking in your brain. Again, I'm doing this because of this, all right? High margin usage. This is the biggest risk to this portfolio. If I was fully in cash, I wouldn't even be investing in treasuries, to be honest. But because I'm investing using a lot of margin, I want to be conscious of that. I want to be aware of that and make sure that I'm doing everything I can to, practice some type of risk management for this portfolio, especially given that, there's high yield ETFs, there's, leveraged ETFs, from Roundhill. And then not only that, I have, again, a Bitcoin strategy in here, which again, Bitcoin is very volatile. Okay. We have Bitcoin being very volatile. I also have MISTI and MSTR in here. So again, those are going to be subject to wild swings as well. So anyways, with that, guys, hope you enjoyed the video. Let me know your thoughts down below in the comments section. What do you think of this? Is this a waste of time? Is this silly? Maybe there's something I didn't think about. I really do enjoy your guys' comments because I get a lot of good information. In this video, why I'm betting big on Bitcoin, MSTR, etc., I got so much good information from other investors that told me to look at it, strike, strife, and stride, or look at this, or think about Bitcoin in this way. It was really valuable for me as the investor to read these comments. So I found a lot of value. So I want to thank you guys for those who did comment on this video. And also in my stock market prediction, I put kind of my thesis out there, and there were other investors kind of explaining, like, hey, this is, another way to look at it. I agree with your thesis because, or I don't agree with your thesis because, there's a lot of those types of comments, and they were all very valuable. So I really do enjoy reading people's comments because I'm learning as well. And, I hope for people who aren't as familiar with finance or stocks or investing or, kind of personal, building wealth and personal finance, I hope that I can at least give you guys something, some type of way to look at this stuff, and definitely, ideas for the future. All right. So with that being said, guys, hope you enjoyed the video. I will catch you guys in the next one. You have a great day.